Okay, so now we're going to look at 11.3, but before we actually look at the book, I want to write a couple things down on our paper to give us some clarification. When we started accounting back in the fall, we worked with a sole proprietorship and a company that had one owner. Okay, and I really don't want a T there. I'm just drawing a line. And that owner, we kept track of that owner's investment in the company and his earnings through capital, and we also kept track of anything that he pulled out of the company through the drawing accounts. Okay, so now again in this second part that we're working with, we're adding merchandise to a company, but they're also a corporation and not a sole proprietorship. So now we're looking at what a corporation accounts look like. Okay, and capital actually changes names and becomes retained earnings. And so this is basically the same thing as capital, but with a corporation and you have all the stockholders, we call it retained earnings. And then for drawing, what goes back to the owners in dividends. Your owners are your stockholders. So dividends are what are paid to stockholders based off of the earnings and the profit of the company. Okay, so in this section, what we're going to look at is the board of directors declares and then the company pays dividends. So company's been doing well. The board of director in a corporation, they're going to have a board of directors that kind of directs the vision of the company, and they're going to decide when it's time to declare dividends to the owners. So people that have bought capital stock, okay, are going to get dividends for this company. They knew that when they bought the stock, that they would get dividends. Not every company gives dividends to every kind of stock. So you kind of have to know what you're buying, all right? But in this case, we are going to deal with dividends. And so we're going to do two transactions. One is when our board of directors declares the dividend, okay? And so when that happens, we're going to debit a dividends account, okay, which is basically like debiting drawing, because that right there is decreasing our retained earnings or our capital, okay, at that point. That's like the owner taking out drawing, okay? When we did drawing, we used a debit. Okay, that's the normal balance for drawing. It's going to be the normal balance for dividends. When we do that, at that moment, it becomes payable to our stockholders. So the other part of that, the credit part of that, is to a payable. Okay, and then when we're ready to pay it, we'll decrease that payable with a debit, and we'll actually write the check. Okay, now we've moved to the cash payments journal. We'll write the check for the cash credit. Okay, so those are the two transactions we're looking at here. Our board of directors declares the dividend, makes it a payable, and then we're paying the payable. Okay? All right, so let's look at the transaction real quick. It gives us again the page number. On the 15th, December 15th, the board of directors declared a dividend of $2 per share. Capital stock issued 6,000 shares. Okay, so there's 6,000 shares out there. They're worth $2 a share, or they're not worth $2 a share. They're getting a dividend of $2 a share. Okay, so after this transaction, they're going to divvy it up between the different owners, but for this initial transfer, we're just doing it as a large group. So 6,000 times 2 would be $12,000. Okay, and then we're going to pay the cash a month later. Okay, because they have to get ready. Once the board declares it, they'll record it, but then they have to get everything ready to actually transfer that cash over to the owner. So there's usually a time span in there. Okay. All right, so the first transaction, and we're using page 12 of the general journal. And this is on December 15th. Okay, the board is declaring a dividend. So our dividends is our debit, and it tells us that this is done with a memo 112. Okay, and it's $12,000. Okay, and this is because they gave a dividend of $2 times 6,000 shares equals $12,000. That's where that number's coming from. Okay, and then at this point it becomes a payable of $12,000. Okay, so this is when we declare, and the board of directors of the company decides when to declare and pay dividends. And this is to the stockholders. Okay? All right, and then at this point, people go into action to get things ready to pay this. And so then on January 15th, they're actually going to pay it. So the dividends payable is going to be our debit. Okay, because here we're saying we now owe our shareholders $12,000. Now we're paying them. So there's our credit, there's our debit to zero that back out. Okay, and we're actually, let me put this, we're on the 15th page. We're actually writing a check for $12,000. And it does tell us that it's check 556. Okay. So we're going back, this is back to our cash payments journal where we've got the special columns. And so it's just going to take one line. There's our debit. There's our credit. This is when we are paying the dividend. Okay. And that's all there is to 11.3 and paying those dividends.